my presentation now. I'm going to talk to you about what's just been going on in the market. So if you just give me 2 seconds, will we get my presentation up on the screen? Here we go. So yeah, I mean, it's been a pretty good time to be invested in the markets. So this is a 5-year chart of the FTSE All World. It's one of the many benchmarks for the global stock market. So during this period, obviously we had pandemic, we've had the interest rates go up pretty rapidly, we've had very uncomfortable levels of inflation, yet stock markets pushed ahead. And if you look actually at the last 12 months, performance has been really good. So I'm not sure if, just in case everyone can't see it, the top two, essentially, it's India and US, about 36% return in 12 months. Germany's about 27%. The UK's even given you 14%. So these are really strong returns. But what makes it really interesting to me is over the last 12 months, we've had this huge list of things for people to worry about. You know, tensions still going on in the Middle East. Elections, people not quite sure what's going on. We've got some clarity, obviously, in the UK and in France now. Not quite sure who's going to be winning the US election. We've had lots of weak economic data. No wonder people have been worried, is the US entering a recession? Lots of excitement about AI, but people are now saying, well, you're spending all this money, when are you going to start making returns? We had the unwinding of something called the yen carry trade, people borrowing in the cheap Japanese currency to invest in overseas assets. The Bank of Japan then puts interest rates up and everyone starts to close out these trades. And that caused a wobble on the stock market over the summer. We've had interest rate cuts, but they're a lot slower than, if you go back a year ago, compared to what we were expecting then to what's happened now. So we've had this big list of troubles, yet the stock market's still doing very well, which basically leaves us in this situation that the bond market's telling us things are not looking good. The stock market is telling us things are looking good. So which one is right? Over the last couple of years, the bond market has been giving some signals that historically have been flashing, this is what happens, and you then get a recession. So longer-term interest rates on US government bonds have been lower than short-term ones. Normally you'd get longer-term interest rates should be higher for the risk of holding them for a longer period. The US stock market has been saying, we think that there might be some economic weakness, but actually, look, the rate of inflation is coming down, and that's what everyone wanted because it meant central banks like the Federal Reserve no longer have a reason to keep interest rates high. So if you cut interest rates, it makes it cheaper for companies to borrow and invest, relieves the pressure on household finances. So all these things are good. So we've had cool inflation. The economy is sort of holding up. There's some cracks in it, but they're still fairly resilient, and the interest rates are starting to happen. So I think it's a very interesting situation. But if you look at some of the messages coming out from companies, they're saying that we should be worried. So I'll give you 3 examples. This chart here is UPS, so the big logistics delivery company. That's not a very attractive share price chart. They've been saying things are not going as well as thought. The latest set of results was customers were saying, we're trying to send things at the cheapest way possible. UPS's growth was pinned on people paying more for premium services. Whirlpool, fridges, and washing machines. What they've been saying is that normally when someone's fridge breaks down, you should go and buy another one, but they're not seeing that. They're saying customers are really weary. They're going to get them fixed. They're not buying new ones. Lamb Weston is a name I wouldn't have thought many people in this room might be familiar with, but it's like the others, it's a really good bellwether for what's going on, particularly in the US economy. They provide chips to McDonald's and Chick-fil-A. They're a real potato supplier. They're saying things are not going well at all. So if you think about all these 3 things, 3 huge companies linked to the state of the US consumer and business as well, not particularly doing that well. Here's an interesting chart which implies exactly the opposite. So this share price chart, you can see from 2020, start of 23 till now, has more than doubled. If I was to say to you, do you think this is a tech stock, an AI one? You'd be wrong. It's Ferrari. So, this is, you're thinking, okay, why is something like Ferrari doing well, but yet UPS is not doing well? Because we've seen signs recently that even wealthier people are being cutting back on spending. But so anyway, what I'm just trying to illustrate is that there's so many different signals at the moment. As an investor, it's quite hard to get your head around exactly what's going on. So I thought I'd sort of put things into 4 different buckets. Pessimism. Well, China, people have been very pessimistic up until a couple of weeks ago on this. Beijing's now throwing lots of stimulus measures, and the Chinese stock market has been doing very well. Commercial property, lots of pessimism about that. But that's starting to turn. Lower interest rates will help. More people working in offices will help. Miners, commodity prices have been pretty bad. We've got a slide in a second. We'll illustrate that with some numbers on it. Skepticism. Banks have had a good time because of interest rates been high, but if interest rates fall, have they had their best day for a while? Oil producers, well, oil price has been in a general downward trend. It's wobbled, it's gone up a bit in the last few weeks, but and UK equity is unloved. Optimism, corporate debt, Japanese equities is probably waning a little bit, and everyone still seems to love US shares. And euphoria, basically, people think that these are untouchable. Anything to do with AI, tech, general, and weight loss drugs. The weight loss drugs thing is really interesting. I mean, you're probably going to see that prices will come down for the products, but production will increase. So, if you talk to someone who's an expert in this area, they still are very excited about it. As an investor, has all the easy money been made in the euphoria? And is this all unloved stuff where you should be fishing? I can't give you the answer, but if you talk to expert investors, they will probably say, you look where everyone else is not looking, and then when all the excitement, that's perhaps you're thinking, okay, if you make good money, think about what you want to do next. Here's some examples of stocks that have done really well. This is last 12 months up until sort of late September. Rolls-Royce, turnaround story, still doing well. Marks and Spencer's, I think if anyone goes there, food's always been really good, but clothes have been a bit, they seem to finally found the right recipe. Quite enjoy going to Marks and Spencer. I don't know if it's just because I'm getting older, but I think as a shop, it's a nice shopping experience. And that's reflected in the business is doing incredibly well. The share price is following it. NVIDIA, just riding the AI wave. Eli Lilly is the weight loss stuff. So the stuff that's not doing well, Rio Tinto was mentioning about miners. Commodity prices have been really weak. Whitbread is the UK, so they own Premier Inn. UK is finding it a lot harder to grow. And then just a couple examples of in the US, Walgreens just seems to be a completely broken business. Lululemon and Nike, problems of their own making. So all of these are actually company-specific issues. Rio Tinto's got no control over the prices of the goods it sells. Commodity prices are not set by miners. That's their one downfall. So what it means is that if you're an investor, you do have to try and look at each company on an individual basis. That big list I've had at the start, things for you to worry about, you can add a couple more on. Well, I did mention about the US elections coming up. We still don't quite got clear about who will win it and exactly how it will impact markets. UK budget is going to be probably, in my opinion, the biggest test for the stock market in the next couple of months. They've hinted that they're going to potentially fiddle with things, taxes for the rich, so capital gains tax. I will have to get Charlene to redo her presentation. I wonder if they're actually going to be a bit more pro-business than perhaps is speculated. Because what they obviously want to get the economy moving. They're going to have to help businesses in a way. But I think that if you've got these issues are going to test things. And if we see that capital gains tax rate goes up, I wouldn't be surprised if we have another wobble on the UK stock market if people are selling out stuff, particularly if they're given a deadline of 5th of April before the rules change. But like I mentioned before, you have to think, okay, is this a threat or an opportunity to me? Because if I was looking at the stuff that's all out of favor and it's starting to turn, if I suddenly see really good companies, the share price fall, should I panic, or is that actually an opportunity to this is a one-off issue? This is assuming what happens to CGT. I don't know the answer. I can't tell you what's going to happen. I can't tell you what to do. But the point I'm trying to make is that you need to think, just don't rush into any decisions with investment. Just be rational thinking. If you have a plan, write down why it is that you're trying to invest. What do you want to achieve? How long are you prepared to invest? What sort of risks are you willing to take? Be diversified. If you put it all into one area and that area goes out of favor, you get caught out. Diversification means having exposure to different geographies, different sectors, so you've got a bit of a cushion if one area doesn't do well. Trying to second guess any of those worry lists, second guess what's happening with the budget or the US election, if you keep trading in and out, it will rack up your trading costs. And it's very difficult to time the market correctly. And just think about regular investing. If we do get ups and downs in the stock market, but you're putting money in on a regular basis, it just means that it will average out over time. You buy high one month, you buy low the next month. Also, if you don't need dividends to support your income, do consider reinvesting them, because that's a really powerful way of driving those returns over the long term. So I'm going to hand you over now to a couple of fund managers, and then we'll hear from James talk about HBL funds. But we will have this question and answer session at the end, so do think of things you want to talk about.